Okay, what's going on, everyone? This is going to be the second video for chapter 6, right? So we're picking it up here and we're starting to look at below the line deductions, right? So we're going to start with our AGI, right? Then we will have essentially that kind of fork in the road. Are we going to itemize or take the standard deduction? In addition to that, you get the QBI deduction. In addition to that, there are these big, beautiful bill deductions. So we're going to start with the itemized versus standard deduction. A little acronym for the itemized deductions, right, can be commit, right? Like you need to commit these to your memory for the exam. So it'll be things like charity, other itemized deductions, medical, interest, and taxes. It's not like a full exclusive list in the sense there are some kind of like minor ones that if you really dug into the code, but for our purposes in this kind of class, those are the ones we're going to look at. And you basically add all of these up, right? So let's just say the standard deduction was roughly, and again, it's inflation adjusted, just say that was 16, right? You had 3 in charity, 5 in medical, and then 2 in taxes, right? You're looking at 10 in itemized. Well, in that case, you would take the standard deduction. You could flip it though, where if the itemized deductions were bigger, right, you would then itemize on there. Okay, so let's start with these. Even though we look at it and we memorize it through this commit acronym, we're not going to unpack it that way, right? We will start with medical, kind of the M in that acronym. So when we talk about medical expenses, right, they have to be the right type of expense, and also they have to not be reimbursed by health insurance. So you got to have like kind of the right thing. And when we talk about that, be typically what you think of like seeing the doctor, prescriptions, transportation costs to the doctors, monthly health insurance, right? All of that is good stuff. It counts. What does not count, right, would be things like general cosmetic surgery, right? Like elective procedures. Maybe you're going to get like a tummy tuck or something like that. That would not be a qualifying medical expense, as well as over the counter medication on there. So that's kind of the first thing. And then the other thing you have to be aware of is if you do have the right type of expense, it's only what is not covered by insurance, right? So yes, I see the doctor and it's $1,000 bill, but insurance pays 800 of that. So I really truly had out of pocket $200. Let's look at an example here, right? They give us some information. Here's a taxpayer. They give us some expenses, right? They go to the hospital. That's good. A prescription. That's good. A therapist. That's good. But right, they were reimbursed by health insurance for some of this. So we take kind of all of those expenses, we back out what was reimbursed by health insurance, and then truly, if you think about it, that's what we paid out of pocket was $1,160. Okay. We have a little framework here, right, that we do have to be aware of. Once we determine those qualifying unreimbursed medical expenses, so it's like you put all of your expenses on there. Let's just say there was, I don't know, 12,000 of medical expenses, and 3 was reimbursed by health insurance, right? So that's going to go and give us, in that case, truly out of pocket for step 1, $9,000 of medical expenses. We have, in this case, a floor that we got to clear, right? Only to the extent till we clear this floor, 7.5% of AGI, is it deductible, right? So let's just take a simple example. Let's say somebody has 100,000 of AGI, right? So here we go. There's all 100,000. In this case, 7.5% of it, right? So 7,500. This is kind of the land of no deduction, right? So what I mean here is if we have 9 total, right, that we calculated, the first 7.5% of AGI, you don't get anything for. It's only that excess, that marginal 1.5 that you would get. So kind of the upshot of this is you have to have significant medical expenses. If you just see the doctor and you pay a couple $100, you're probably not going to clear the floor in that case. And this 7.5%, right, that is not inflation adjusted. That is a fixed number that you need to know. So let's look at some examples here to build off that. This is just saying, hey, we drove. You do get a mileage amount. You don't have to memorize that mileage amount on there. We have an example here of somebody who's kind of in an old folks home. This is one way people itemize a lot, right? When they do itemize, if you have a kind of senior citizen or a parent or a grandparent, they're in one of these kind of medical care facilities where they, it's like $20,000 a month. To the extent we can kind of allocate that to medical, you can get and count it as a medical expense on there. Here is showing that floor, right? So when we talk about charity, you want to think the word floor. When we think about and we talk about, when we talk about medical, you want to talk about and think about the word floor. When we talk about charity, it's the ceiling, right? So C in charity equals C for ceiling. Medical, it doesn't work out the letters like that. But here's an example, right? If we have AGI of 187, that's kind of 7.5% of AGI. If we only have $2,400, you're getting nothing, right? You're all in that land of no deductions. Change it up, right, where you have 1,500, which is 17 or 7.5% of AGI, and you have 2,400 expenses. Okay, 900 cleared that hurdle on there. Okay, so that's medical, right, in the COMMIT acronym. Next, we're going to move to T for taxes, right? So when we talk about taxes, this is generally going to be state and local as well as foreign. We're talking about income taxes, real estate taxes, and personal property taxes. You add all of these up on there. Non-deductible taxes would be federal income tax, federal state gift tax, FICA, foreign real property taxes. Typically you think on like what you make, what you pay on your house. That's the most common with it. One thing to be aware of, right, is if you live in a state where there are no income taxes, right? If you lived in like Texas and Florida, you could choose instead to deduct sales tax. So, maybe you buy a big car and there's a bunch of sales tax on there. In any event, right, what you do need to know is this deduction is limited to $40,000, right? There is a phase out. It can't fall below 10, but the magic number is 40. And essentially, how does this work, right? Say you live in a state, especially like California or New York, it is not uncommon there. Let's just say you made 100 grand, right, where you would pay 15 in income tax, and then your house, when I used to live in New York, for every $100,000 your house was assessed, you would pay 5 grand a year in property tax. So you have $400,000, $300,000 house, you could pay, I don't know, just say $20,000 a year in property tax. There you go, you're at 35. This is the big one, taxes. If there's going to be one that kind of takes you over the hump and lets you itemize, typically it's going to be taxes on there. Do have to be careful, right, because we're talking about personal use taxes here, right? So taxes, for example, on your home. If it was taxes on a rental property you owned, that would go on Schedule E as an expense there. How about interest, right? We'll now talk about interest here. So this is essentially interest you pay, right? So if you buy a house, right, maybe you buy it for $300,000 or $400,000, whatever the number is, right? Every month you're going to pay some principal, you're going to pay some interest on there. In this case, we're talking about interest that is used to buy, build, or improve your first or second residence. So typically like where you live, your main home. They're going to show you this on the 1098 mortgage interest statement at the end of the year. So you just get a document that says, here's how much interest you paid. Again, typically it's where you live. It also includes, as a general rule, mortgage points, right? So sometimes, say like the going interest rate for a loan on a home is like 6% or something. You could theoretically pay the bank, maybe $5,000 or something, and they would lower the interest rate down to 5% on there on the loan. That's mortgage points. It's a form of prepaid interest. If you do it when you first buy the home, that's deductible. Also, when we talk about interest here, it's interest paid on home equity lines of credit assuming you use it to buy, build, or improve the home. So what is a home equity line of credit? Hey, I own my house outright, or I own it more than I owe on the bank, so I have some like true equity in it. I want to update my kitchen, for example, and I basically borrow against the house, right? Maybe I take out a $30,000 loan on there against the house. Depending on how I use those proceeds, if it's to basically improve the home, then the interest on that loan is deductible. But if I just use it for kind of personal fun reasons, like, hey, I'm going to borrow against my house and go on a vacation, that's not deductible. So it comes down to that kind of use of those HELOC proceeds. There is a cap on this, right, for the amount of interest that's deductible, and it really depends on when you took out the loan, right? So it's kind of like old school alimony versus new school alimony, right? If it was basically 2016 and beforehand, we have one set of rules, and then on there, end of 2017, into 2018, so I'll just put 2017, 2018, it's a different set of rules. Basically, they cap how much interest is available based on the amount of debt on there. So let's just look at an example down here, right? Because this is kind of current law if you've got a house right now. Say that you wanted to buy a house, it's 2024, 2025, 2026, whatever the case is, and you are a millionaire, right? You get a $2 million mortgage. I'm getting my kind of McMansion up there, and it's a 7% interest rate. So you might think, right, that, hey, we would get all of the interest on this loan, right, as a itemized deduction. Well, no, that's wrong. You only get it up to, in this case, $750,000 of that amount, right? So in other words, of the $2 million mortgage, right? So it says here how much interest you would pay is $140, right? That's the total kind of gross interest that you pay. Of that amount, $52.50 you do get to deduct, right? $750,000 worth. The remaining mortgage, the $87.5, the interest on that mortgage is not deductible. So they kind of cap it on there for the amount that's associated with it. How about another type of interest, right? So we talk about home mortgage interest, typically interest you pay on a house, right, on that loan. It can also be another type of interest, investment interest. So hey, maybe you borrow some money from the bank, right? You use the proceeds from that to buy taxable investments. So not muni bonds, but things like stocks, traditional bonds, lands, other items that are investments. And essentially when you borrow it, right? So let's say you borrow 100 grand, you buy that stuff, that's great. And then you pay interest on that. Let's just say you paid $6,000 on the borrowing. You can deduct this interest as an itemized deduction if you itemize, but there is a cap to it, right? So it's limited to the taxpayer's net investment income on there, right? So if you have $6,000 of interest that you paid, but hey, on all this stuff you got, right, your net investment income was, I don't know, let's just say if it was 10, right, you could deduct all 6, right? It could, theoretically take you down to 4, you would itemize there. Assuming again it was greater than the standard deduction. Compare that with, okay, our money that we made from this, our net investment income from that was we made 4, right? Even though you paid 6, the best you're going to deduct as an itemized deduction is 4. It's limited to that net investment income on there. Again, we've talked about this before. There's no deduction for kind of personal interest paid, so things on a credit card. Most automobiles, we'll talk about an exception there at the end, assuming you meet a certain criteria, but the general rule is no deduction for personal use autos. Penalties and interest, student loan interest above the deduction, HOA fees, insurance, assessments on there. So again, just being aware, like you only get these itemized deductions if it's specifically laid out. All right, next, let's talk about charity, kind of the C in that commit acronym, right? So maybe you want to donate to the charity, right? The cute panda bear from the World Wildlife Fund. When I was growing up, professional wrestling was called WWF, but then they got into this big dispute with like the panda company and they had to change it to WWE. But when you donate to a qualified domestic charity, right? Typically a 501c3, you could potentially get an itemized deduction. Do be aware at times in history, they did give you an above the line deduction for a small amount, like a couple $100. But for purposes of this class, we are going to assume that all charitable donations are itemized deductions and it has to be to the right organization, typically a 501c3. There are some nuanced rules here. You can read through this, kind of workarounds or tricks you can do for a donor-advised fund and a qualified charitable distribution. Also, be aware, right, depending on how big the amount you give, you are going to have to get some type of acknowledgement of it, right, a receipt. And if it's a big donation, right, like you want to give like a boat or something fancy on there, you will have to get an appraisal to make sure that basically what you're claiming as the deduction represents what that thing is worth. Now, again, it has to be the right type of organization, right? What does not count, right? What you would not get are political and lobbying contributions. In other words, they're not going to fund the Trump campaign, the Harris campaign, whatever the case is, politics through tax donations or tax deductions. That's not going to work there. So no political, no lobbying, not private organizations, right? Like country clubs aren't going to count. Foreign charities don't count, right? None of these are good. It has to be a domestic, like a U.S. charity. And then personal gifts to other people, right? All of these are bad, right? Frowny, you don't get, right? So like if you were, for example, to give to a GoFundMe page, right? Like, you know, everybody wants a GoFundMe now for like every like life event, that wouldn't count. If you were to see a homeless person on the street and you gave them a $20 bill, that wouldn't count. It has to be a registered charity, okay? So we talked about, right, it has to be the right type of charity, right? Typically a 501c3. Okay, we give stuff. Now we're going to talk about how do we put a dollar amount on that, right? Well, if it's money, right, you give them money, straight up cash, it's easy. It's the fair market value. Hey, I give the Red Cross $1,000 in cash. There you go. It's $1,000. If I give them property, right? So I'm going to give them a table. I'm going to give them a stock. I'm going to give them my car, right? Something other than money, then we do have a rule set. We basically have to look at that property and say, if we were to sell this property today, would it generate a long-term capital gain, right? i.e., we've held it for more than a year. If so, then the general rule is we're going to use the fair market value of that. If not, right, if it's not capital gain property, for example, it's a short-term capital gain, then it would be ordinary income property. So basically we'll look at that 1 year mark. Oh, okay, we sold this. It would be taxed at ordinary rates, like up to 37%, not that preferential rate of 0, 15, or 20. In this case, we would pick the lesser of the fair market value, what it's worth, or the adjusted basis. Typically, that just means what we paid for it, right? That's the general rule, the general framework. We will see there's an exception, right? So up here under the capital gain property, if it would be tangible personal property and you meet that capital gain treatment and we know that the charity is going to use it in a way unrelated to its charitable purpose, then we depart and use the adjusted basis. So the general rule here is fair market value. The exception is adjusted basis when it's tangible personal property. The exception to the exception, right, this is like going in 3 layers deep, would be if you give a vehicle. Then if you give a vehicle to the charity, it's worth whatever they sell it for. This isn't going to make sense the first time you hear it, right? Like when I look at this, it's like, oh, it's obvious. I deal in this every day. You're going to have to see numbers, see problems, and we'll do that. But this kind of mental map is a good way to unpack it. So let's take it one at a time here, right? If you, for right now, just get the map here, get the basic rules, the blocking, the tackling the fundamentals, that's good enough, right? We will start with money right? So typically it's going to be just straight up cash. It could be a check, or it could be you could charge it on your credit card. One thing that you do have to be aware of that does not count is personal services that you give to the charity or any use of property, no cost use of property. So let's just say, hey, I'm a CPA, I do books and records. I'm going to go to the church and do their books and records for free. Typically, I would charge $5,000 to do this. Can I get a $5,000 deduction? No, I can't, right? Nothing for services on there. However, like driving to charity, right? I want to go volunteer at the Red Cross, right? Well, your mileage for purposes of volunteering would be good. Also, let's just say I have empty space available in my warehouse, and I'm going to let the charity run an event there, right? Typically, I would charge $1,000 for somebody to run an event here. Can I get a deduction for $1,000? No, you can't. Okay, so got to keep that straight. Typically, it's money, it's not services, and it's also for the net donation, right? Basically, you have to back out anything that you got in return, right? So let's say I give $100 to the Save the Kids donation or whatever, the Shriners organization there, and they give me this adorable teddy bear blanket for free, right? And let's just say that thing is worth $20, right? In that case, I will only have made a charitable contribution effectively for $80, okay? So that's kind of the first thing with money, right? We can kind of do that. Typically, it's what you give. Now, let's look at property, right? So we said you have to, this is basically if you give anything other than money. So I give a stock, I give a bond, I give a table, I give a car, I give my shirt, right? In this case, what you need to do is essentially look at the property and say, if I were to sell this today, like immediately before I were to donate it, would this generate a long-term capital gain, or would this generate a short-term capital gain? Basically, you look at that 1 year mark on there. How long did I hold it? If it's capital gain property, the general rule in that case is going to be fair market value, whatever it's worth on the date of donation, that will be the amount. If it's ordinary income property, it's going to be the lesser of the fair market value or the adjusted basis. Okay, so here's capital gain property. General rule is fair market value. Let's look at some examples here just to give this kind of numbers, okay? All right, so 614, they're talking about, hey, here's all our taxes related for that. We add them up. Oh, okay, we'll get that. That's below $40,000, okay? Here's some mortgage interest, right? You can see, hey, we took out money to borrow on a house. We paid some interest. You could see that it's deductible on there. All right, now we have charity we're talking about, right? We give some money to the Red Cross and $200 to friends, right? The only thing that would count is to the Red Cross. Those kind of gift to friends are not eligible. They talk about, hey, we volunteer at the Goodwill and we, drive there. Well, that's great. The only thing you're going to get is the driving, the mileage deduction. Again, don't memorize that. But your value of your services you do not get. Now we're getting into valuation, right? So here's an example. Whoa, geez, zooming in there. We have a taxpayer. They give stock, right, to the charity. Looks like they paid $2,600, and on the date of donation, it's $10,600. So it's appreciated in value. How do we do this? Right? Well, we gave property. They held it for more than a year. It's long-term capital gain. When we put a number on this donation, it's going to be the fair market value as a general rule. Okay? We will see there is an exception to that, right? So the general rule is fair market value, but the exception is if you donate tangible personal property that's long-term, and we know that it's unrelated, the way the charity is going to use this is unrelated to its charitable mission, or they're just going to straight up sell it, then we use the adjusted basis, right? So let's say we donate a painting to a church. Here we're going to give you kind of the Mona Lisa to the church. They're not going to sell it, right? How do we value this? So let's look at some examples here. All right, so the first one says we give that Mona Lisa to the church. We paid $2,600 and it's worth $10,600. We think that the church is going to use this for its tax exempt purpose, right? Maybe they're going to hang it up and it's like somehow religious, or it somehow helps them. We know that they're going to use it in kind of furthering its mission. In that case, if we give tangible personal property, it's long term, and we know that they're going to use it in a way that's related to its mission, we'll use fair market value. However, say we give them the painting and the church is like, look, we want nothing to do with this Mona Lisa. They're just going to sell it. That is to say, they're not using it for the tax exempt purpose. Then we will use the adjusted basis. Okay? So you can look through those kind of other examples there. It gets wonky too, because if you give a car, right, and like you say, oh, okay, they're going to sell the car, then just for cars and boats, there's a separate rule that says, okay, we don't use fair market value. We don't use adjusted basis. Instead, whatever the church or the charity sells that car for is what we get the deduction, right? So we're getting down there, okay? How about ordinary income property, right? So we did this, right? Let's look at ordinary income property. We bought this. We held it for a couple weeks or something. If we sell it, it would be short-term ordinary income property. You pick the lesser of the fair market value or the adjusted basis. So let's look here. We donate clothing, table, and a couch to the Goodwill. They held it for less than 1 year, which means it's short-term, which means it's ordinary income property. We paid $900. Right? So in other words, our adjusted basis is $900. At the time of donation, right, our stuff is only worth $160. We got to pick the lesser of those two. Hey, there's the number that we would put on there. Be aware there is a ceiling for charity, right? So C and ceiling, C for charity, right? This just means there's a maximum amount that you get for charity, right? So for cash, for example, it's limited to 60% of your AGI on there. Don't memorize all these, right? It's a lot of like random memorization. Just be aware there is a cap. You can't just like deduct all of it, right? If you have like 100,000 AGI and you give 80,000 to charity, the most you could probably get is 60,000 on there. Continuing. Casualty and theft losses. So as a general rule, you're not going to be able to deduct casualty losses. So your car is destroyed in a flood. Your house is destroyed in a tornado, right? Sorry, you don't get anything from the tax code. The exception is, say it's a federally declared disaster, right? It's Hurricane Katrina. The president says, hey, this is a disaster. My house is destroyed. In that case, you can deduct it, but there's kind of rules here. You'd have to take the loss, right? So maybe my house, I lost 400 grand, insurance reimbursed 300 grand, right? I got to back out $100 floor, right? That's the amount of loss for that event, right? For each kind of casualty loss, my house, my car in the federally declared disaster. You then add all of those up, like A, B, C, my house, my car, all these other items in the federally declared disaster from step one. You back out 10% of your AGI, and only to the extent it clears that are we able to deduct it, right? So it's kind of like medical on there. You have to have significant losses compared to your income. Okay, gambling losses, we've talked about this, right? You have to report your winnings separate from your losses on there. So your winnings come first, and then if you itemize, you can potentially deduct the losses. If you take the standard deduction, you get nothing on there. Losses are capped, right? Currently, they're capped up to winnings, right? So if you win 1,000 and you lose 2, right, the most you can deduct is up to what you won on there. So that's for 2025. That changes. Just assume for the exam that they're deductible up to all of your winnings. It's a different story if you're a full-time professional gambler, right? Say I'm like a full-time poker player and it's my job. then you would be able to deduct the losses. But if you just lose in your fantasy football league or like a parlay or something, you don't get anything. So Schedule A is where you would show those itemized deductions. And that was kind of the whole thing with that kind of commit acronym. You could see lots of twists and turns. Let's compare that now to the standard deduction, right? Typically, it's a flat amount, right? Like for example, when you have to look at the the year on there, but like for right now, for example, it's around $16,000. That's going to be the general rule. There are exceptions, right? If you're old, you get potentially an additional standard deduction. So you're old or blind so this is around $2,000. You'd have to look at kind of the textbook and the amount for the year. You get this on top of the 16, right? So plus 2, say you're 70, right? You would get 16 plus an additional 2 on there, whatever the amount is for the year. So that's the first exception. Or if you're young, right? Your standard deduction is modified if you're young. In this case, you don't get anything on top of it. Instead, your standard deduction, it's not 16, right? In other words, if someone claims you as a dependent, so this might be you, right? Mom or dad claim you as a dependent, then you would look at your return and be like, hey, well, where's my 16,000? Did Keith teach me the wrong thing in class? No, right? If you're claimed as a dependent of another, right, your standard deduction is the bigger of essentially a threshold amount. Again, you have to look at the book for the exact number. It's around like $1,300, $1,400. So I'll just put, $1,300 here. Check the book to make sure if you're doing the homework, the exact amount for the year, or right, a different threshold amount, right, plus the taxpayer's earned income. So I think for this year it's around $450. Again, you have to check the book on that, plus the earned income. So for most people, right, if you don't work or anything and you're claimed by mom or dad, your standard deduction will be $1,300. But let's look at some examples here. Right, so there's charity you can look at. Don't memorize those specific ceilings. This is a good one to see though, and I would give you those kind of threshold amounts on the exam if I were to test this. Okay, so we have someone who's head of household. The flat amount of the standard deduction for them is $23,000. Okay, that's great. If they have 37 of itemized deductions, will they itemize? Well, yes. In that case, 37 is bigger than the 23. But now let's focus on their kid, right? So maybe this is you, right? So say you earned $600 cutting grass, right? What is your standard deduction? You may say, well, shouldn't I get 16, right? Well, no, that's wrong. If you're claimed as a dependent by somebody else, your deduction is the greater of the threshold amount, $1,350, or another threshold amount, $450, plus your earned income, that grass income. So in this case, right, the bigger of those would be $1,350. There you go. Change the facts, right? Say you earned a lot more from cutting grass. The bigger would be that over there, the threshold amount. But say that the bigger, right, was you earned $16,000 from cutting grass. In this case, right, you're ultimately capped at the standard deduction. So you say oh, okay, I'll keep getting my income bigger and bigger over here because it gets bigger and bigger over here. This is ultimately capped at whatever the normal standard deduction would be for the year. Bunching, you can look at, this is essentially a timing strategy with bunching, right? You're trying to avoid taking the standard deduction year over year, and you time your itemized deductions whereby you can get use of them and itemize in 1 year. So say we have 15,000 standard deduction for both years, and there's 10K of charitable deductions on there in year 1, in year 2. So if you think about it, right, you don't have enough to itemize in any given year. In year 1, you would take the standard deduction. In year 2, you would take the standard deduction. So over a 2-year period, right? So in total, if you look at it for 2 years, you got 30,000 of deductions. Compare that with the taxpayer bunching, right? We will shift the timing of these charitable contributions. We'll collapse all of them into year one, right? Meaning we will itemize in year one and then take the standard deduction in year two. Over a 2-year period, right, we now have 35,000 of deduction. So it's basically shifting. The framework to think about bunching is like, man, it's hard to clear that standard deduction. To the extent I have control over these itemized deductions, let's try to like force it through, like do it all now versus spreading it out to get me over the hump to itemize. Okay. QBI, right? We'll talk about this kind of quickly. You don't need to know much about this for the exam. I'd keep it very basic. In the TCJA, right, they took the tax rate from 35 down to 21% for C Corps. The partnership owners were kind of like, hey, what are you going to do for me? And they gave them essentially this QBI deduction, which more or less is a 20% deduction for flow-through income. It's now going to be inflation adjusted, of course, moving forward, but you can just think of it as a 20% deduction for the right type of income that goes through. You get that on top of the standard deduction or itemize, right? So QBI, what is it, right? It's basically net income from a qualified U.S. business. Basically, if you're a sole proprietor, you're a partner in a partnership, a shareholder in an S Corp, or an LLC that's taxed in any of these ways, right, then you would get the QBI deduction, right? So say I'm a sole proprietor, I have a Schedule C, 150 of revenues, 50 of expenses, right? I net out there just my net income of 100, I would get, in that case, a $20,000 QBI deduction. Likewise, say I'm a partner in a partnership, I get a K1. It shows, hey, my share of the ordinary business income, basically the net income from the partnership, was 200. I could potentially get a QBI deduction for 40,000, 20%. It gets wonky, right? Don't go down the rabbit hole of looking at these. Just be aware of that's the end of the rainbow, the 20%. There's a lot of things that can take that down, okay? All right, now we're moving to the big, beautiful bill deductions, right? There's really 4 of them here. If you qualify, you get them, right? And a lot of these were last minute promises whenever Trump was running for president. It's like, hey, we're not going to tax tip income. Let me get your vote. Hey, we're not going to tax Social Security. Let me get your vote. They are temporary, right? So in the sense that when he leaves office, whoever comes in next, right, gets to kind of inherit this. So it's not forever. But essentially with qualified tip income, you can deduct up to $25,000. It has to be the right type of industry, right? Like if you're a waiter or waitress, obvious it's customary there. But I can't, as a lawyer or something, say, oh, don't pay me like my fee, just give me a tip so I don't have to claim that as income. Let me get the deduction. No, it's not customary. It is subject to a phase out. You must file MFJ to get it. And one of the things here is for the tip income and the overtime income, it's still subject to FICA or SE tax. So if you're work for an employer, right, you pay FICA. That's how we fund Social Security and Medicare. If you're self-employed, you pay SE tax. Again, it's basically the same tax how we fund old people stuff, Social Security and Medicare. You still have to pay this, so that 15.3%. So it's not absolutely no tax on tips. It's just no income tax on tips. And if you qualify, you aren't phased out, and only up to $25,000. Do be aware, right? If you work in a service industry, and I never claimed my tips in the past, and now I'm going to claim it, obviously you should. You're required under the law. But this now leaves an audit trail, right? If in the prior years you had no tips and now you claim 20,000 in tips, they're going to say like, what's going on there? And likewise, when this thing goes away in 3 years and you want to go back to before how you were doing it, there's an audit trail. So tip income up to $25,000, it's phased out. Don't memorize that phase out. Similar thing for overtime compensation up to 12.5, right? So I would, you can note 25, 12.5, these aren't inflation adjusted. Similar thing, right? Has to be qualified overtime. There's a phase out. You have to do MFJ, still subject to tax on there. The other one is qualified car loan interest. So generally, as a general rule, car interest is not deductible. The exception is if it's a qualified car loan up to 10 grand. So basically what this is, it's I buy a new car, right? I borrow money to buy this new car and I pay interest on it. That new car must have been finally assembled in the US, right? So we're trying to encourage people here to buy US cars, or alternatively cars that were made in the US. I pay interest on that car loan, I can get a deduction for it. Okay, so new cars that were finally assembled in the US. There's a lot of like information you have to put on here to get this, but that would be a deduction. The final one was Trump's kind of promise in the campaign for no tax on Social Security. So this isn't a Social Security deduction, but it kind of acts like it, right? If you're 65 plus, you can get a $6,000 deduction. Again, you have to do MFJ, and again, there's a phase out. Okay, so there's a lot of information there, not something you're going to hear once and to be able to kind of immediately get. Let's say watch the lecture again on like 2x speed, fill out the class notes. That will get you at a good spot. But I'm going to end things